Hello students, in the previous class, we discussed what are the different accounts that are being prepared in any organization to know whether they earn profit or loss. So today, and even we discussed about the trading account, manufacturing account, and profit and loss account. Now let us understand how do we prepare balance sheet, what are the things that will appear in the balance sheet, what is the need for the preparation of balance sheet. Let us understand about all those things. So in today's class, we will try to understand about the preparation of balance sheet, its pro forma, what are its limitations, what are its adjustment entries. That all we'll try to understand in the today's class. So in final accounts, whenever any organization is preparing the final accounts, in that final accounts, the first comes the trading account, profit and loss account, then comes the last one, that is balance sheet. Here in balance sheet, why actually we prepare? In trading account, we will try to understand what is the profit, that is gross profit we have earned by the purchase and sales. And in profit and loss account, we will understand what are the expenses that are indirectly related to the sales and what are the incomes that the organization is earning, and that is called net profit. And this net profit is carried or transferred to the balance sheet, that is to the capital account. So now in balance sheet, here we will write assets and liabilities. Means actually balance sheet means it's a statement which shows what it owns and what it owes. Means what the organization is having by its own thing and what the organization has to pay to the outsiders. The balance sheet shows what are the what how much the organization owes to others and how much the outsiders are owing to the organization. So now in this, so balance sheet is not accounts we write over here, and profit which we bring from the profit and loss account, that also will be written over here. Now in balance sheet, it shows it's an equation. If you can just look at here, this is the equation which states that balance sheet assets is equal to liabilities plus equity. Now what are assets, what are liabilities, and what is equity? Now in this, assets means what the organization owns by itself, like building, like plant, machinery, motor car, or any stock, cash in hand, cash at bank. These all are owned by the company. And we have a term called sundry debtors, where the outsiders are due to the organization. Now, liabilities means where the organization is owing to the outsiders. Like capital, as we have discussed in the earlier class or in the first class, business entity concept, where we have differentiated the difference between the owner and the business. whatever the owner is bringing in the form of cash and which is called as capital, that will be treated as a loan or due to the owner. So whatever capital the owner has brought, that is treated as the equity, or we call it as equity. And liabilities means any loan taken from the bank or any loan taken from outsiders, that all are liabilities where organization is due to the outsiders. And also we have a term called sundry creditors. Means whenever the organization is purchasing from supplier, it means on credit basis, in that situation, the organization is due to that person and that persons are called sundry creditors. So these all come together, we call it as liabilities. So balance sheet shows what all the organization is due to others or what organization is due to others, that will be shown over here. Next. So here we have a form of balance sheet. We have two orders of balance sheet. One is liquidity order, the other one is permanence or fixity order. So let's see, and also we have horizontal, that is T-shape form, or vertical form. Like unlike how we were having profit and loss account in both the things, vertical form as well as the horizontal form. Similarly, balance sheet is also prepared in horizontal form as well as in the vertical form. So this is the T shape, that is horizontal form. In the order of liquidity it is. We just look at here. We have current liabilities. Means here liabilities means whatever the organization is due to the outsiders. Whatever the organization is due to the outsiders, we call it as current liabilities. Like bank overdraft. Bank overdraft means any bank overdraft facility is provided only to the business person and also who is having current account with the bank. And whenever anything drawn over and excess of your bank balance, that is a liability. It means as a organization we are due to the that bank, that is bank overdraft. Next we have outstanding expenses. Means expenses means normally it's an expenditure. We normally write either in the trading account or profit and loss account depending on the expenditure. But here outstanding expenses means expenses which are not yet paid. We have not paid. So we have to pay. It's a due. So we are writing as a liability. Next, bills payable. We have to pay. We have not yet paid or we are paying. So it's a liability. Next, sundry creditors. Sundry creditors arises because of credit purchases. Pre-received income means we are receiving our income in advance. So in that case, actually it does not belong to this year. For example, X has to pay rupees 500 to the organization in the next year, but he paid in the current year itself. In that case, we are received in 1 year before. It means we are due to that person. So that is also a liability, that is current liability. Next comes fixed or non-current liabilities. Fixed or non-current liabilities. Here, fixed or non-current liabilities, we have loan taken or any borrowings you have taken or loan from the bank. Proprietor's capital means owner's capital. And owner's capital, again, if you can just look at here, we have different under that. We have opening balance, that is additional capital. Means, for example, when the business is started, the owner may start business with some capital around 5 lakhs or 10 lakhs. But when the business is expanding or it's increasing its sales and everything, the owner may invest some more capital into the business. So that capital is called additional capital. Whenever the owner is bringing an extra amount into the business, apart from capital, that is called additional capital, or it is also called as further capital. Next, whatever net profit we get from the profit and loss account. Profit we received, which we have balanced in the profit and loss account. If we will add it here to the capital, and if it is a loss, we will deduct it. And drawings means the owner has taken. Means whatever amount we are due to the owner, that liability has decreased. So we will deduct it. So this is how the liabilities are written. Next, we look after the assets. Under assets, we have current assets. Actually, I have to tell this. current liabilities and current assets means the liabilities which we can pay them within a period of 12 months or in a 1 year, that are called current liabilities. Current assets means the assets which can be recovered, which we can receive from the other outsiders within a period of 12 months or 1 year is called current assets. Here you can just look at your cash in hand, cash at bank, marketable securities means if you have done any investment and which you can sell within a period of 12 months or 1 year, that is a current asset. Next, prepaid or deferred expenses means any expenses which you have paid in advance. For example, you paid insurance. Normally, any financial year will be 31st March. But you paid till June because you have taken till June, it will be extended till June. Means you have paid extra 3 months. That is prepaid. You are paying in advance. So in that case, it is an asset. Prepaid expenses. Next, accrued income. Income which has yet to be received. The income which has not yet received but has to be received, that is called accrued income. It is also a current asset. Next, bills receivable. The amount which is receivable through the bills, and mostly it arises because of sundry debtors. So these two which can be, because whatever sales be done on credit basis, the customer has to pay the amount within a period of 1 year. We cannot give more than that period credit. So in that case, we are going to receive this amount within a period of 12 months. So this is also a current asset. Inventory or stock means whatever stock is left over. When we are doing accounts, I have found that in my shop, that is stationery, because our example is a stationery shop where my stock is pens, books, and pencils. In that case, if any books are left over in the, when I'm calculating, I have seen that there are 100 books. So these books I will not keep as it is. I will sell, but how much period I will take? I will not keep more than 1 year. I will convert the stock into cash within a period of 12 months by selling that stock. So that is also a current asset. Next, we have fixed or non-current assets, which will be there with the organization for a longer period, like investments, stock of loose tools, furniture, fixtures, fittings, plant and machinery, which will be there for the organization for more than 10 to 15 years or 20 years or for the longer period in the business activity. In that case, that is called as fixed assets or non-current assets. You can even see land and buildings, office premises, patents, trademarks, goodwill. This all together we will find out these are liabilities and these are assets. And this is in the T-shape form, and that in the order of liquidity. Liquidity means when you can easily convert into cash or you can easily pay or clear your liabilities within a period of 12 months. So on the basis of liquidity, this format has been given. Liquidity means you can see, just look at here, all these current assets, cash in hand, cash at bank, marketable securities, prepaid. These all can be easily converted into cash within a period of 1 year. And here also current liabilities, bank overdraft, outstanding expenses, bills payable. These all can be cleared or this can be paid within a period of 12 months. Next, here liabilities. Loan of capital or whatever capital low investment done by the owner in the form of capital, that can be cleared only at the end of the when we close the business or winding up of the business. At that time only capital will be paid. So that is the reason this has been given at last. And here all these assets which can be converted into cash or only when the organization gets into liquidation or winding up, at that time only this will be sold. Otherwise, until they will not be sold. So that is the liquidity format of balance sheet. Next, we have the order of permanence or fixity. Fixity means reverse of that one. This was how we are easily payable or receivable. Then in that format they given. Now, how much long period they are going to be with the organization? Based on that, this permanence is given. You can just look at here, the reverse of that one. So capital will be there throughout the business until and unless the organization closes or wind ups or goes into liquidation, the capital will be there with the business only. Similarly, long-term borrowings. After that, loan will take for 20 years, 25 years for a longer period. Next, current liabilities. Income received in advance, under creditors, bills means this can be uh, paid within a shorter period. So that is why this is given last preference. Here, fixed as under assets, we have fixed assets. Under fixed assets, we have goodwill or other intangible assets, land, building, plant and machinery, motor vehicles, furniture, fixtures, loose tools, investment means this all will be there for with the business for a longer period of time. That is permanence. Now this is vertical form. That is horizontal. Now this is vertical form of balance sheet. Same balance sheet, but in a different format it is given. Same we will have current assets, current liabilities, fixed assets, and non-current liabilities. So if you just look at here, first they are given fixed assets, then investments, current assets, and they deducted here current the same format, the same transaction or same items will be presented here, but the position it differs. So you can just look at your fixed assets, investments, current assets, and they deducted it from it deducted current liabilities. Then we get net current assets, our total assets. Then comes owner's fund. Under owner fund, we have capital and reserves and surplus, secure loans and unsecured loans, and total liabilities. So again, in depth, they given what are current assets means nothing but the floating assets or which can be easily converted into cash or which are already available in the form of cash or which can be easily transformed into liquidity. They are called current assets. Fixed assets means which are acquired for a longer period of business, which will be there for 5 to 10 years or more than that years with the business for the smooth running of business and may include both tangible and intangible assets also like patents we have franchise copyrights license these all comes under intangible assets and tangible assets you can take land and buildings office premises plant and machinery motor vehicles furniture fixtures loose tools this all. So we have limitations of balance sheet that is we have four limitations that is liquidity or short-term solvency, debt repayment capability or long-term solvency, operating capability, overall financial strength means we can understand this from the balance sheet and its limitations are static document means it's a only on that particular date we are taking and we are not able to write anything after and before the transactions takes place. So only between that dates it is prepared. So after that, if any changes takes place that are not noted or not reported in the balance sheet or not viewed. Next comes complemented by a valuation document. Why? Because it's a historic activity that are already taken place and governed by varied accounting policies, susceptible susceptible to window dressing. There is a chance because showing what is not there, it may show it as if it is there. So if you can just look at the balance sheet, they given one question, you can have a glance over this. From the below given balances, You are required to prepare and show a balance sheet as on 31st March 2018 as it appears under. Prepare and show a balance sheet as on 31st March 2018 as it appears under. That is, first one is order of liquidity, order of permanence, and vertical form they are asking. If we look at the question, the given capital, investments, cash in hand, furniture and fittings, bills payable, sundry creditors, drawings, closing stock, and loan given to Mr. A, business premises, cash at bank, bills receivable, sundry debtors, machinery, net profit, loan taken from Mr. B. And if you look at here, capital is a liability, investments is a asset, cash in hand is also an asset, furniture and fittings is also asset, bills payable is a liability, sundry creditors is a liability, drawings we will deduct it from capital, closing stock is an asset, loan given to Mr. A, it means we have given loan, so it is the asset to us. Business premises is an asset. Cash at bank is also an asset. Bills receivable is also an asset. Sundry debtors is also asset. Machinery is also asset. Net profit we will add to the capital, and loan taken from B. We have taken loan, so it is a liability. So first now with the same things, if we can just look at here. So it's a liability. It is an asset. So again, asset you have to decide it's a fixed asset or non-current asset. It's a current asset. It is also again fixed asset. Furniture. Bills payable is a current liability to us. Sundry creditors is a current liability. Why current liability means the expenses or the liabilities which we can pay off within a period of 12 months. Drawings we deduct it from capital. Closing stock is a current asset. Loan given to Mr. A is a fixed asset. We have given, so it will be more than 5 years. Business premises is also fixed asset. Cash at bank is a current asset. Bills receivable is also current asset. Sundry debtors is also current asset. Machinery is a fixed asset. And net profit we will add to the capital. And loan taken from Mr. B is a liability to us. So now first we will look after this in the form of order of liquidity. Liquidity means which we will pay within a period of 12 months, that will be written first. Okay. So here first we have taken current liabilities, so which we can pay off clear easily. Under that first one is bills payable, sundry creditors. And fixed liability they have loan taken from B and proprietor's capital. To that they have added even net profit and deducted drawings. Why they deducted drawing? Because drawings means anything withdrawn by the owner for his personal use. So whenever he's taking means first he has given some capital to the business, and when he's taking for his personal use, we will deduct it is from his capital. That is the reason we deduct it is from capital. And you even just look at here, cash in hand, cash at bank, bills receivable, sundry debtors, closing stock or current assets, and fixed and non-current assets are investments, loan given to Mr. A, furniture and fittings, machinery, in business premises. So this is in order of liquidity. Next we look at the order of permanence. Permanence means which are for longer period. So it will be reverse of that one. So first it will be capital. Next comes for into that capital we will add to that we will add net profit and we'll deduct drawings. Then we have long-term borrowing, that is loan taken from Mr. B, current liabilities, sundry creditors, and bills payable. And under fixed assets, we have business premises, machinery, furniture and fittings, loan given to Mr. A, and investments. And under current assets, we have closing stocks and so this is in the order of permanence. Whichever are there for with the organization for a longer period, that will be written first, and which are going to be clear off or receive within a period of short period, that will be written at last. Next, we have vertical form, and in the vertical format, this is the format, and this is how we write in the vertical format of balance sheet. Fixed assets means what we will do here. If you just look at these, all are fixed assets. These all are added together and investments are excluded and written over here. This is 7,23,000, 4,50,000, 2,48,000, 25,000 and 50,000. Together 7,23,000. It's added separately and written in a schedule and written over here. Fixed assets are 7,23,000. Next we have investments and current assets. All current assets put together. These all are added together and written here 3,79,000. And we have current liabilities and provisions. So these are current liabilities 1,88,000. This is deducted. Instead of writing here and there, it's as it is in vertical form. They deducted here, and whatever the balance is, that is net current assets, and total will be again total assets. Now owners fund, that is liabilities, they have taken capital. So capital here only 5,50,000 minus drawings. Why? Because net profit will be written under a separate schedule. In that we write under reserves and surplus, we write net profit. Capital here means capital minus drawing. Capital here means capital minus, that is drawings. So the here capital means, so the owner capital is 5,50,000 minus drawings 28,000. It comes to 5,22,000. So this will be written over here. Capital means this is how we'll get the 5,22,000. Next, under reserves and surplus, they write only net profit or any profits or any reserve, that will be written under schedule, that is reserves and surplus. Next, they have secured loans. So here they don't have any secured loans, only they have is unsecured loan, that is loan taken from B. So again, I have to put together, added here total assets, and this is total liabilities. Like this, balance sheet will be prepared. That is only normal balance sheet. Now for this, we will have some adjustments. Means whatever the changes that takes place after preparation of ledger accounts and trial balance. Now that all changes will make in the final accounts. That is in the trading account, profit and loss account, and balance sheet. For example, if it is given closing stock as adjustment, so where to write that? Whenever closing stock is written, there are two effects. One we write in the trading account. The other effect we write in the balance sheet asset side. Trading account credit side, that is one effect of closing stock. The other effect is balance sheet under asset side, under current assets we write it. That is the effect. And the entry is closing stock account debit to trading account, or closing stock account debit to trading account. Next, outstanding expenses. So there will be certain expenses which are not yet paid. There are certain expenses which are not yet paid. So what should be done? When there are certain type of expenses, then we have two effects. One is we will add to that uh, specific expenditure or specific respective expenditure. That is one effect. And other effect we will write in the balance sheet liability side. The other effect we write in the balance sheet liability side. Here, if you closing stock, we write in one effect, we write that is the credit effect, we write in trading account, and the debit effect, we write in the balance sheet asset side. Next, outstanding expenses, expenses which are not yet paid. First effect, we write in the, if it is related, that expenditure is related to trading account, we write in the trading account. If it is related to the profit and loss account, we write in the profit and loss account. For example, they given outstanding wages. Wages will come where? Wages will come in trading account. So in that case, we will first add to the wages that outstanding expense, outstanding wages, and other effect we will show in the balance sheet under current liabilities. Balance sheet current liabilities. For example, if it is outstanding salaries, so in that case, we will write in the profit and loss account and we will add it to the salaries. So depending whether the expenditure is related to trading account or profit and loss account, we will add to that respective expenditure. That is first effect. Another effect we will show in the balance sheet liability side. Next comes prepaid expenses. Expenses which are paid in advance. Normally, the phone recharge, what we do, we take for 3 months or 84 days or 90 days. We first we pay, then we use. Yes, here also we are paying some expenses in advance. Whenever the expenditure, why? Because why we are deducting? Because the expenditure does not belong to that particular year. So we will not take into consideration. It belongs to the next year. That is the reason we are deducting. So whenever there is a prepaid expenditure, we will deduct it from the particular expenditure or respective expenditure. Again, it will be trading account or profit and loss account. Prepaid expenses, the first effect we will deduct from the respective expenditure, and the other effect is balance sheet asset side we write it. That is current assets. Next we have depreciation. Depreciation we will debit it to the profit and loss account and we deduct it from the respective asset. For example, depreciation on building is given. As it is an expenditure, we are assuming it's an expenditure. We write in the balance profit and loss account debit side. And other effect, I deduct it from the building. That is from balance sheet. So one, I'll write a debit it in the profit and loss account. The other one, I'll deduct it from the respective fixed asset. Next, bad debts. Further increase in bad debts. Means already there is some bad debts are there in our books. Again, they given extra to increase the bad debts. What to? We will debit it to profit and loss account. In addition to the existing bad debts, means already some 500 is there. They are asking us to increase to 1000. So we increase that. So we add, means we write again, or we add it to the respective bad debts. And the other effect, we will deduct it from sundry debtors in the balance sheet. Why? Because sundry debtors arises because of credit sales, and these people are the only one who will not pay to the organization. When they do not pay, in that case, it becomes bad debt. So we will deduct it from sundry debtors. Next is provision for bad debts. I said it's an assumption that it may happen. So not to incur the loss in the future at a time, we make a provision in the name of bad debt. So what we will do means we will debit it to profit and loss account if in addition to the bad debts and total amount of provision required. So this is Bad debts is different, provision is different. Provision means we are assuming that in future also we may get a loss. So not to have that or to cope up with that loss, we are making some provision. So we debit it to the profit and loss account and we deduct it from balance sheet, sundry debtors. Next, provision for discount on debtors. This is also related to the sundry debtors. So the obviously the effect will be we deduct from the sundry debtors in the balance sheet and we debit it to the profit and loss account. Next, reserve for discount on creditors. So this like as an income, though it's not an income, it's a gain to us. So we write it in the profit and loss account credit side and we deduct it from sundry creditors. Next, we have accrued income. Accrued income means for expenses we call it as outstanding. Incomes we call it as accrued. For expenses we call it as outstanding. For expenses we call it as outstanding. And for incomes we call it as accrued. When expenses which are not yet paid, incomes which are not yet received, which we have to receive but we have not received yet. So in that case, for incomes we call it as accrued and for the expenses we call it as outstanding. In expenses, what we did, we added to the respective expenditure. And in profit and loss account or trading account, expenditures will be on debit side and incomes will be on profit and loss account credit side. So in that case, what we will do, we will add to that respective income. Here they did not mention, but they have to keep here. We will add to the respective income and we show it on the balance sheet under current assets. Next one is pre-received income or income received in advance. So any incomes which are received in advance, we deduct it from that income and we write it in the balance sheet liability side. Let's look at the problem, one full-fledged problem through which we can understand the adjustments also. From the following trial balance of Sri Ramnath Traders, a sole proprietary concern prepared trading and profit and loss account for the year ended 31st March 2018 and balance sheet as on that date. So they given debit column and credit column. Stock means it's an opening stock. Why? Because first, if you can just look at here, the 31st March they are asking 2018, but they given stock of 1st April 2017 means it's the opening stock. Opening stock we write in trading account debit side. Ramanath capital. Capital is a liability. Drawings we deduct it from capital. Purchase and purchase returns. So this purchase and purchase returns we write in trading account. From purchases we deduct purchase returns. Next, sales returns and sale. This we write in trading account credit side. From sales we deduct the sales returns. Next, wages. These are direct wages we write in trading account debit side. Next, salaries. Salaries are related to the indirect expenses. So we write in profit and loss account debit side. Next, we have cash. Cash is an asset. Bank balance is also an asset. And freehold premises is a fixed asset. Trade expenses is expenditure we write in profit and loss account. Next, commission received 10% investments as on 1st April. So it's an investment. It's an asset to us. Interest on investment means whatever investments we done on that we get the interest. It's an income to us. So we write in profit and loss account credit side. Sundry debtors is as current asset and sundry creditor is a current liability. Next, income tax, discounts allowed and received. Discount allowed is an expenditure, discount received is a gain to us, not expenditure, it's a loss to us. So we write it profit and loss account debit side. And discount received is again we write in the profit and loss account credit side. Office furniture is as a fixed asset. Printing and stationery is an expenditure we write in profit and loss account. Rent and rates, insurance, advertisement expenses, bad debts and provision for bad and doubtful debts. Now, bills receivable and bills payable. Bills receivable is a current asset and bills payable is a current liability. And rent received is an income. Now, look at the adjustments. Wages still unpaid means outstanding wages. With this, we have two effects now. One effect, uh, one effect we write it, we add it to the wages in the trading account, and the other effect we write in the balance sheet liability. Say that is under current liability or under liabilities we write it. Next, stock. This is closing stock. One effect we write in trading account credit side, and the other effect balance sheet asset side. Balance sheet asset side we write it. Next, write off annual depreciation of 5% on premises and 10% on office furniture. So they're asking us to write off depreciation. So depreciation first we write in uh, profit and loss account debit side. And if you look at here, we have even depreciation. So depreciation means we will deduct from, we will show it on profit and loss account debit side, and we deduct from premises and we deduct from office furniture in the balance sheet asset side. Next, insurance to the extent of 600 relates to the next financial, means this is nothing but the prepaid expenditure. Next year also we paid now itself. So what we will do, we deduct it. Next year does not belong to the current year. So in that case, what we will do, we will deduct that from the respective expenditure. So from insurance, if you just look at here, insurance is 3,100. Insurance is an expenditure. We write in profit and loss account debit side, and from that we will deduct this 600. Next, you can just look at your opening stock purchases to wages they added here, and they've shown here under balance sheet liabilities side. Outstanding wages. Here it is. And now first we will discuss about the bad debts. Further bad debts are rupees 1,000. We just look at your bad debts. Already their bad debts are 2,000. and provision for bad and doubtful debts is 1600. So just look at your profit and loss account. Bad debts already existing 2000. Addition, how much is asking us to increase? To increase one more 1000. So what we are doing? Just we are adding to that. Write off means we would have deducted. But what is telling? Increase. Look at here. Further bad debts means increase one more 1000. So we are adding one more 1000. So bad debts is 3000. Next, and here we deduct it from debtors. We deduct only adjustment 1000 bad debts, not profit and loss account, whatever given in the trial balance. This is called trial balance. And whatever the adjustments are given, only this will have two effects. Adjustments items or adjustment transactions only will have two effects. Trial balance items will have only one effect. That is the reason we are not taking these bad debts in the balance sheet. We take only profit and loss account. And this is the 1000 further bad debts, which is given in adjustment. We take in two places. One is in profit and loss account, the other is in balance sheet asset side from sundry debtors. So these further bad debts we add in profit and loss account, and in balance sheet from debtors we deduct it. Next, provide for bad and doubtful debt 6% on sundry debtors. So how much is asking to provide? 6%. Already they were having 1600. Just look at here. So whatever debtors are there, on that they will calculate. 48,000 minus 1,000, 47,000. Yes. On that they will calculate this 5%, this 6%. And this 6% is nothing but the 2,820. So when if you look at here, already old, this is called old provision. This is old provision for bad. This old provision for bad it's 1600. Now new one, how much we got? 2,820. How we got 2,820 from here? Why? Because 100 are already 48,000 minus 1,000. So you get 47,000. So when you write here 47,000 into 6%, 47,000 into 6%, we will get the 2,820. When old provision is less and new provision is more, in that case, we will deduct the existing provision. And the difference we write in the amount column. And when you come here in the balance sheet, you will deduct the new provision. You never touch the old provision in the balance sheet. In the balance sheet, we'll have only the other effect of adjustments only. So here we write the new provision, that is 47,000 into 6%. You will get 2,820. 47,000 into 6%, 2,820. And in profit and loss account, what we did? Because already it was less. Actually, it should be 2,820. But how much we provided? We provided 1,600 only. So we are going to face again loss. So in that case, what we will do? We provide extra provision. That is extra is 1,220. 1,220 we provide the extra provision. And even if they are asking discount on debtors, that is 3%. So discount on debtors means first what we will do on debtors we have to find out. Means sundry debtors already 48,000 minus 1,000, 47,000. From that you have to deduct 2,820. You will get 44,180. You will get 44,180. How you will get? Actually, debtors are debtors are 48,000. So this is the sequence you have to remember. From this, first we will deduct bad debts. And bad debts we having is 1,000, which is given in the adjustment. From this, we will deduct. When you deduct it, you will get 47,000. And from this, then we will calculate provision for bad and doubtful debts. provision for bad debts. And this provision on this. So on how much they said? They said 6%. So how we are going to calculate 6%? We are going to calculate 6% on 47,000 into 6%. So we'll get 2,820. This is new provision. And from this, we deduct, you will get 44,180. Now, on this amount, we will deduct discount on debtors. So, this is the sequence you have to follow. Discount on debtors. And discount on debtors is 3%. So, on what you will calculate? On this balance, you will calculate. That is 44,180 into 3%. And that is 1,325. And the balance is 42,855. We write over here. This is how we prepare the adjustments and we do the problem which is related to the balance sheet. I hope you all have understood. And tomorrow in the next class, we discuss in the next session, we discuss about the next topic.